Buying a home soon, but you have questions on credit scores, down payment, loan types, and more? Tune in because we connected with Sol Skolnick at United Mortgage to go over all of those topics for you.
You would always want to be on the side of having good credit.
Do you think it pays to have good credit? So I want to thank you so much, man, for joining the It Pays to Have Good Credit podcast. I've been waiting to do an episode with someone who's in the mortgage industry and ask a few more questions about some of the things our clients are having concerns about. And I think you're the guy to ask those questions to, man. And again, I thank you so much for reaching out to me, wanting to be a guest on this episode. We love it when people from different, I want to say not necessarily industries because we kind of relate a little bit, but different professions, right? So that comes in handy, man. So before we get into those details and questions and all of those topics, I want to let you have the floor here, introduce yourself to our audience, who you are, where do you work, how can you help people, who do you serve, which market do you serve, and we'll go from there, man.
Okay, thank you so much. I appreciate
Yeah,
the time and the opportunity for us to chat. So,
absolutely.
my name is Sol Skolnick. I'm an NMLS licensed mortgage originator and mortgage consultant. I'm also an author, not just on mortgage books, but currently on mortgage books. I mainly lend in the states of New York and Connecticut, but my bank, which is United Mortgage, is a national mortgage bank, so we can lend everywhere except Hawaii and Alaska. So I work with a team, in different states who have the same properties and same kinds of programs that I do.
Okay.
Um, I've been doing this for 20 years. Just before the crash, I got in 2006. So, as they say, I've seen it all. I've seen the high and the low. I've seen the end of the world and its resurgence. And I'm seeing whatever it is we're seeing now, which I couldn't begin to explain to you.
Absolutely. Yeah, absolutely. Well, let me bring this up because I feel like this is affecting not only the home buying industry, but every industry that's out there, man. Is it really impacting the mortgage industry a lot? If we look at groceries today, things are expensive in the stores. We look at gas stations. I'm here in Arizona. It's costing me $5 per gallon just to
Right.
fill up my Silverado, and that gets expensive, right? So when it comes to people buying homes and, home prices are steadily going up, the interest rates on homes are going up. Do you see that this is becoming a impact on your industry, or as far as your business, do you see where people are not really interested in buying a home in today's market, or is it actually the opposite? What is your opinion
Well,
on that?
I think people are still interested. I think they have to do the math differently than they would have done. The first thing they need to understand that when a bank approves you, they're really just approving you on principal, interest, taxes, and insurance. The
Mm,
bank's not sitting there and going, "What's it going to cost you for electric? What's the gas going to cost you? What does it cost you to do so many other things to maintain the home?" And so it's really important for a potential home buyer to put that into their budget, even if they've been approved for a certain amount. They might not want to be writing a check for that amount if they're
yeah,
accustomed to renting for a different one. It's also had an effect in that with prices having gone up and some of the rates having gone up, a lot of people who would normally be empty nesting, moving on out of certain areas, especially in the suburbs, aren't leaving. And so the houses that would normally become available for younger families by and large, or single people looking to move out of the rental cycle and into a home purchase, aren't seeing the homes be available. My wife and I just sold our home where we lived for 37 years,
mm,
raised our family there. Years ago, when we bought it, there were 6 or 7 homes on that same street for sale at about the same time because of empty nesting. We were the only ones for sale because there were other people who simply said, I don't want to side size. It's difficult to downsize unless if you're moving out of New York and Connecticut and moving to one of the Carolinas or
right.
elsewhere in the West, maybe that's going to be downsizing. But if you're thinking about staying within an hour of where you currently are, it's really going to be side sizing if you're lucky.
Oh, for sure. Well, let me also bring this up because I think, man, this is the number one question that a lot of our clients have. We get so many people who sign up for our credit repair program who are trying to dispute negative items. They may have collections on there that they have no idea what it is, whatever the case is.
Sure.
And the first thing that these people come up with, hey, Chris, I'm trying to improve my credit score. I'm trying to buy a home. What is the minimum score that I need to be at? And I can understand where these people are coming from, but I don't necessarily always agree with that question because I feel like people are just trying to be at that very minimum spot. If their credit scores are a 550 and you tell them they need a 620, a 640, a 650, they don't care about the 700s. They just care about getting that score to that 620, 630, or 650. So, I don't really agree with that because all of the mortgage lenders or realtors that I'm affiliates with and I help them out, they refer their leads to us, we refer leads to them, vice versa. A lot of times when we send people over and they get to that minimum credit score range, and I could be wrong. I just feel like there's always a road bump that is stopping them from actually moving forward towards closing. I can't count on both hands and feet how many times I've been told to send someone over when they got to a minimum credit score. And once I sent them over, something else was wrong. DTI was wrong, or there were still things on the credit reports. Although the score got to that minimum
Right.
range, there was still something on the credit report. So, how do you feel about the term minimum credit score? Is that really a thing? Because I just feel like
Well,
so many other things matter.
yeah, the only reason that it matters, and it doesn't matter ultimately in how you get your loan, it does matter that there are certain programs that have a minimum score built into them. So you need to be able to know ahead of time if somebody is looking for a jumbo loan and the minimum
Mm,
for the jumbos that we have are 700, they need to know that nobody's going to be able to even look at it without the 700. If they're
mm,
looking for an FHA, there are some lenders who can do that at 580, others who might want you to be at 620. So it's really just a minimum in terms of the way it's written in for the underwriter rather than it being very important. The real important thing is getting the credit score high because there are three elements to what the loan's going to cost you: credit score, DTI, and LTV. So
mm.
and at every 20 points, there's a slightly different tranche. So it's at 640,
Oh,
you're going to
wow.
pay more for the rate than you would at 700, even if the minimum for that product is 600. The issue is what's it going to cost you to get the rate? Because the rates are
Right.
laid out in, those three things in relationship to what is the rate today for that particular product.
I see. Makes sense. And with DTI, I'm assuming different loan types have different minimums for DTI and credit scores and things like that.
Absolutely.
Okay. So I'm assuming USDA is one of the easiest loan types to get approved for, and then it's FHA, I think.
Well, USDA, first of all, is all about geography. You have to be in an
Mm,
area that is seen as rural. And
yep.
the definition of rural has to do with how many people live in a square mile
I
from the
see.
government. So if
I
you're,
see.
coming to Stamford, Connecticut, there's not going to be a USDA loan because somebody lives 6 inches from you.
Yeah.
Um, FHA, it's the same thing. There is a certain minimum from the government, but each lender might have an overlay. So the government may say 580 is okay, but lender X may say, gee, we want it to be at least 620 before we're comfortable.
Mm,
Um, Really, the issue is what program is appropriate for you? Where does your income come from? How long do you expect to be there? What are your requirements in terms of the
mm,
house and the area? So, putting all those things into it is really most important in terms of the kind of loan. And then, yes, each loan has different parameters. The DTI for a certain, for a $900,000 loan is going to be lower than for a $600,000 loan in
right.
general.
Right.
And the mortgage banker, the person who does what I do, or what's sometimes called a loan officer, needs to tell the potential borrower up front, this is what you need to get the minimum into this program before we can even look at it for you to get you approved. And that
Mm,
should be very simple. It's written out, we all have a computer, we all hit three buttons
mhm.
and it says, this program requires X, Y, and Z. Then there are
Yep.
other things to make it easier or harder, but the basics of what is the outsize of the program, we should know pretty much.
Absolutely. Well, people who are enrolled in our service, And I don't really get into so much of the mortgage details because I just rather just send somebody off to a mortgage loan officer who can answer all of those questions. I just hate giving out wrong information.
Sure.
But so many people call in and they're like, hey, what score do I need for down payment assistance and all of these third party programs to help them buy a home? And I'm like, look, I don't know anything about that stuff. I can help you with as far as being familiar with different loan types. I understand
Okay.
that USDA, I know they have like zero down options if you're in a rural
Mm,
area, of course.
right.
And then FHA, I believe they start at 3.5% down.
Right.
And then conventional, I believe they have as low as three. I don't know if that's true
Yes,
or
they do.
not, but yeah,
Fannie and
three.
Freddie now have first-time home buyer programs that are as low as
Yep.
three. And
Yep.
again,
So
what's also becomes important is where
yeah,
are you looking? So things are
exactly.
going to be different in different geographies. It's very
Yep.
simple. You know,
Right.
what may work in Buffalo, New York is not going to work in Phoenix, Arizona. You need to talk to a banker who's in that area and saying, this is what works here where we are. This is what my lender, what my program is because I'm here with you.
Absolutely. And I'm going to use this to clip this because I think I want to just post this episode or this clip or this section I'm about to bring up because I feel like I say this so many times. Is down payment assistance a so-called free grant to buy people a home if they qualify for some crazy qualifications out there? Because correct me if I'm wrong, I'm pretty sure it is a secondary loan on the home that you're purchasing, correct? How does that work?
Well, it's both, and it really depends on where the program, and the programs are going to be different depending on where they come from. So there are
Mm.
programs that come from local governments. There are programs that come from organizations. There are programs that come from companies. So each program is different. And again, somebody needs to say to you, Christopher, in your area, if you have this criteria, if you make less than this amount or more than this amount, or make left turns in the right-hand lane, we're going to give you potentially the down payments assistance. Some of them are free money.
Oh,
Some of
wow.
them, yeah, some of them are grants. But again, the loan officer needs to say, this is what we have available. Let's see what you might be qualified for. And again,
I
it's going to
see.
be very different in different parts of the country and literally different times of the day.
Okay. Yeah, because, I'm just one of those guys, and I'm sure people feel the same way about the credit industry, working on credit scores and things like that. I get it. I look at a lot of things like that, but there's so many crazy, misleading things in life today. And anytime I hear someone, they're like, hey, I'm trying to get approved with the minimum credit score. And I also want down payment assistance, but I don't want to pay it back. And I'm like, look, you're just going down the wrong path. I don't think that stuff exists, but that's why I'm here. And I love bringing on guests who are in those professions because now I can learn and also educate the audience who are asking me these questions. So, it's always good to keep learning. I'm not one of those guys to think once I get to a certain spot, I can't continue to learn because, man,
Sure,
there's so much about the mortgage industry. Although I talk to so many mortgage professionals, I just
sure,
don't sit there and bug them every single week, bringing up questions to them because that is not my industry completely. Although I kind of relate to it because
of course.
99% of my clientele are people who are trying to get a mortgage. So,
Right.
it's always good to bring those things up when I get guests like you joining this episode.
Well, one of the ironies of the down payment assistance, so in certain areas, it's based on median income. If your median
Mm,
income is below a certain amount, you might be eligible for it. But here's the bad part. If that's what your income is, you're not going to find anything in some of those areas to buy. So a
wow.
place like Westchester County, the median income is just over $100,000. If you're making $87,000, you may be eligible for something, but I don't know what it is you're going to find to buy in
I
terms of what
see.
the pricing is. So again, income assistance and down payment assistance should never be the leading edge of why you're going to get a mortgage. You should be
I see.
trying to put yourself in the best position and then say, okay, what might I be eligible based on, my background,
Yep.
my culture, my work, or my whatever it is. There are lots of different programs. You ask, mortgage person should know. If they don't know, find a different mortgage person.
There you go. Yeah, easy as that. Well, a lot of people like to, and this is just outside people that I see comment on some of our social media posts and things like that. We all know who Dave Ramsey is, right? He's one of
Mhm.
the guys who became a debt-free billionaire. I wish I can be that one day, but I think a lot of his points are a little misleading, like I was just bringing up in the previous topic there. He's just real big on getting wealthy or becoming a better version of yourself by not being trapped in America's debt trap, right?
Mhm.
So, things that I disagree with him on is just completely ignoring using credit correctly to your advantage. Like me as a business owner, I use my Wells Fargo business card every single day for business transactions. Now, by all means, I am not a billionaire. So if I can make free cash back or free travel
Mhm.
points or anything like that, I am going to use that to my advantage because I am not a billionaire like
Right.
Dave Ramsey. So, I just cashed out like over $2,000 on my Wells Fargo credit card just from expenses over the last, I want to say, probably 9 or 10 months here. And that $2,000 can buy me plane tickets. It can, get reimbursed to my card to where some of my
Mhm.
expenses are free or whatever the case is. And, I just disagree with him on some of the things he talk about credit. I think credit is very useful if you use it correctly. And I'm sure you can agree with that. Now, what I'm getting to, Dave also talks about buying a home with credit. Unfortunately, is one of the only things that he do agree with using your credit for because not everyone have $500,000 saved in their bank account today. He understands that, luckily.
Mhm.
Now, his argument is he do not want people financing a home if it's over 15 years, and I believe it has to be under 20% DTI, total debt. Now, I know most mortgage lenders, I think they have front end and back end
They
DTI. I
do.
think front end for homes is 31%, maybe for FHA. I don't know. But I know total, if you don't have any debt, I think some lenders may go up to 40, 43%. Who knows? I'm just kind of estimating from what I've learned over the years. So, do you think that is a safe spot to where the traditional limit for DTI is for most consumers, that 40% or 30%? Do you think that is safe for consumers or people who max out their pre-qualification? Do you think they're silly for doing so? What is your opinion as someone who's in the mortgage industry? Where do you think people should be, or how should they at least consider their pre-qualification and their DTIs and things like that?
What I always tell them to do is this is what it's going to cost for principal, interest, taxes, and insurance.
Yep.
This is what it's going to cost for other things. This is your existing debt. Write that check. How do you feel when you wrote that check? Does it
Yep.
hurt? Does it feel uncomfortable? If it feels uncomfortable, back it down. If it feels like it'll be okay going forward, that might be right for you. There is no, I mean, because there is no absolute way to do it. It's really, what do you feel like? The bank's going to say, depending on the program, some are going to be 28% up front and 40% in the back. There are programs that go to over 50% on the back end. Is that okay? For some people, yes. For other people, no. And again, it's individual. There is no, it's sort of when people say, if the rates go down 1%, should I be refinancing? Well, if you have a $200,000 mortgage and that's going to save you 27 cents, maybe not. But if you have an $800,000 mortgage and it's going to save you $89.90, is it worth it to you? It's all
Yeah.
about what is it worth to you? What does it feel like to you? I'll give you the numbers in terms of our requirements. I'll show you what is okay with the lender. You have to tell me how you feel about it. And you have to,
Hmm.
whether it's an individual person or a family, say, okay, if we're writing this check, if we're spending this amount of money, how will we feel about that? That really is what I suggest to people to do. Because in terms of the maximum number or the minimum number, I'm not going to change it for you. It is what it is. What does it make you feel like? How
There you
comfortable
go.
are you?
Right. Absolutely. Yeah. I think I'm the same way with DTI. Everything that I have, I would assume financed in life, homes, cars in the past, anytime that I got approved for something, obviously I fit that DTI requirement or limit. So, obviously I'm approved for it already. I'd never purchased anything and moved forward with it if I felt that it was making me uncomfortable or I felt that it was going to put me in a bind. So, I can kind of see Dave Ramsey's crazy, viewpoint on 20% max DTI, but I just feel like, look, only you yourself understand what your bills are every month, what your expenses are, what is your lifestyle like. If you like to take multiple vacations and you have kids and things like that, well, you may need to look at a lower price item that's going to lower
Yeah.
your DTI and things like that. If you're a younger adult and you may not have kids, or maybe you just have one kid and you don't really care about traveling every other month or something like that, well, you may can afford that home that's going to put your DTI a little bit higher. So I definitely agree with that. Now, kind of related, but somewhat different, is there a true advantage or disadvantage with going with a 15 versus 30-year term?
Okay. So here's the point. Before the pandemic, the average loan was held on to by people between 5 and 7 years.
Yep.
Now, some of that was because people were moving, some of that because the rates were changing,
Yep.
so they could lower, some of that was to take cash out. It's kicked up a bit after, it's sort of 7 to 12 years at this point. So the real first question you ask is, what is this house to me? Is this a 5 year house? Is this a 3 year house? Do we think this is going to be, the lifetime house? We know there's no such thing for real, but, is this the long one? Are we going to raise our family for the next 18 to 20 years, in theory, in this house? So
Hmm.
you need to look at that to say, okay, during that time, how much money do we want to create in equity and what are we comfortable with against spending? The 15-year is going to give you less interest over time, dollar-wise, obviously, than a 30-year, just based on time. And yes, you will have um, equity more quickly.
Right.
But here's the contrast. 30-year notes have more programs to them. So you can get an adjustable rate, adjustable for 3, 5, 7, or 10 with a 30-year
Mm,
note, where you can't get that with a 15-year note.
I
You
see.
can get an interest-only loan with certain 30-year notes. You can't get that
Mm,
with 15. So the number of alternative ways of looking at it within the quote unquote 30 years, knowing full well the number of people getting to 30 years isn't enough for both of your sets of fingers and hands
yep.
in proportion. It just isn't going to happen. And again, when the rates go down, a lot of people are going to refinance. When people need cash, they're going to refinance. People sending their kids to college, they're going to refinance,
Yep.
or they move. People, again, we lived in the same home for 37 years. We are in the minority in terms of that number. 5 to 7 years before things turn over is much closer to the average. And again, people need to know, where are you? First time home buyer, 2 bedrooms, 1 bathroom. You're trying to have kids. Okay, maybe it's only 5 years. Moving in with the 3 kids you already have. Gee, we're not looking to go anywhere till they're all finished with college, let alone going to college.
Right. Right.
So, and again, looking at programs where you can get an adjustable rate in a certain amount of time may be to your advantage. Interest only, where you say, gee, I don't really care about building additional equity other than the value of the home. I just want to pay some of the interest and I'll use that money to invest in other things or to do
There you
other
go.
things. And
Yeah.
that's why I do what I do, so I can have those conversations with people, then let them go back home and figure out what works for them, what do they think will work for them, and then hope we've made the right decision.
There you go. Yeah. Well, talking about going back to the economy earlier, and this just made me just think about something else. We talked about how everything is expensive in today's world, gas, groceries, just going shopping for just random stuff. I mean, you walk out of your front door and it's going to cost you $100, right?
Mhm.
There's people right now who are enrolled in our credit service to where they're just struggling making a service payment, and I get it. There's people who are relying on their credit cards to pay their bills, yet these are people who are in the market to eventually improve their credit scores to buy a home within the next few months, which I think is a little bit of a rush and crazy, but no big thing. But what I'm getting at, buying a home today is very expensive. You have closing costs, you have down payment, you have potentially your realtor fees, whatever the case is. Outside of that, the cost of moving, furniture, utilities, it is a very expensive item to purchase in today's world. So, with some of these loan programs that requires a 3.5 or 3%, 5%
Mhm.
down payment, and then you have your traditional 20% down payment with conventional. I think that eliminates PMI, private mortgage insurance, if I'm
Mhm.
correct. Do you think in today's world that people even care about if PMI is added? Because I don't think many people have 20% down today's world to just eliminate PMI. I honestly don't think people care about PMI if they can save 17% down payment and just put a 3% down payment down. That's thousands of dollars, tens of thousands of that versus what their mortgage being a few bucks higher per month. What is your opinion on down payment today? Do you think that people are purposely not putting 20% down in this world's economy, or is it more common than I think?
Again, I think it really depends on geography and it depends on income level.
Yep.
A lot of people still are looking at 20%. I know we've seen more and more people get gifts from family members for their down
Mm.
payment. 5 or 7 years ago, it was not unusual to get a gift of 7,500 or $10,000. I
Yeah.
see people coming in now with the gifts of 50, 75, and $100,000 for down
Golly.
payments.
Dang.
And again, depending on the geography and where you are, that becomes more common than it used to be. I was talking to a friend yesterday whose son is currently in high school and say, well, if he wants to buy a house in 5 years, I'll gift him $100,000. I'm
Wow.
going, okay,
Dang.
adopt me. Um,
Yeah, same.
um, so, yeah, I think, again, you have to figure in the mortgage insurance as part of your monthly payment. What does it do to how you write checks each month and how you feel? You do create more equity when you put down a larger amount. And there's margin between 3% and 20%.
Yeah.
10% down will still get you mortgage insurance, but less of it and more equity up front. Same thing with
Mm.
15%. So, you have to do the math and figure out how it fits. I don't think anybody says, ignores the mortgage insurance. You can't. It becomes an expense. And also, quite frankly, depending on which program, the FHA, that mortgage insurance virtually never goes away. With some of the Fannie and Freddie programs, when your equity does build to 20%, and it can be a combination of what you pay for your mortgage as well as the cost of the house in the market, that mortgage insurance goes away. So different
Hmm.
programs let you hold, slide and get away from it after you build more equity. One program doesn't.
Well, let me ask you this because I'm curious about myself. So I just moved around the Phoenix, Arizona area 8 months ago now. And I just purchased a home and I did a ton of upgrades to it. So let's say someone, if I were to just put 3.5% down, just went the
Mhm.
FHA route, I'm paying PMI. How would the bank determine when my home is 20% more than my current loan balance? Because I've done so many upgrades, pools and luxury interior designs and things like that. Let's just say I've
Mhm.
done all of that. Would I have to go out of my way myself to get my home appraised and present this to my bank and let
Nope.
them decide, or do they automatically just, come up with
No.
something?
Well, in banking, nothing is automatic. So let's start there.
Okay.
No, we can't use your appraisal. We have
Okay.
to hire an appraiser as a third party who would go in there and then compare it to homes that have sold in the last 90 or 120 days
Hmm.
within a geography and saying, okay, your house, which now has three new bathrooms, a new kitchen, and a new roof, you spent $120,000. If you were to sell it on the market tomorrow, it would be $87,000 more than it was worth to you 7 months ago. And then you need to say, okay, am I going to refinance? Or do I, why am I asking them this in order to lower the MI? But no, you have to get the bank to do the appraisal, to cause the appraisal to be done, and then see where it takes you. And again, having put some equity into it each month as part of your mortgage payment, if you're doing it that way, plus the improvements should give you a new value to the home. And
Okay.
the increased value, will get you a higher LTV.
Yeah, yeah. So if my LTV would look better, and this is just for any random person that's out there in a situation like this, or even better, would they be able to keep the same loan or would they have to refinance in order to get PMI eliminated?
Well, no, you can get PMI eliminated without going to a new loan. I mean, if you
Okay.
can get the appraisal for that, but if you then want to take any money out of it or change the rate,
Yeah.
you do need to go through a refinance. But no, if you can show that it is now worth, you now have 21% in equity, um, through an appraisal that the bank will help have,
Yeah.
you can get it done.
Absolutely. Well, my next thing is going to transition more into my space here. I deal with so many clients who sign up and they either pay these collection accounts, but the balance still shows $0 and the collection item is still on their credit. And I get so many lenders that still would not approve them, even though they paid these collection accounts. It didn't do anything to their credit score. They just cannot move forward with some of these people who have collection accounts within the last 12 months. And like I said, regardless if they're paid or not, they just cannot move forward with closing or whatever the case is.
Mhm.
A lot of times these lenders, they can't even issue I don't know if it's just a pre-qualification or maybe they can't go through closing if the account is in dispute status. Are you familiar with that?
Yeah, if it's in dispute status, it means that whatever the underwriter is seeing can't be final. So
I
if it
see.
hasn't been resolved, the underwriter can't give you a decision. It's not
Yeah.
because they don't want to, but if something is open-ended, even if it will ultimately be in your favor,
Yep.
there's no way for the underwriter who is now responsible for the money that the bank has lent, to sign off on it. So
Yeah.
you need everything to be closed up and done so that the approval can't be broken by something that you didn't fix.
I see. Yeah, because man, over the last, I want to say 2 or 3 years, I've had at least, I want to say, man, probably 30 to 40 people that went through a situation to where either their realtor has called me or texted me, or maybe their lender has called, emailed, texted, or whatever. And they're like, hey, Chris, we need this account out of dispute status so we can move forward. I'm like, wait,
Mhm.
you want me to stop working on their credit, keep the account on there, and just let it naturally get out of dispute status or request it to be removed as far as the dispute being removed, and they can move forward. Then what was the point of this client signing up? So I was always confused on that, on why purposely take the account out of dispute, stop what we're doing, and you're good to move forward. So I always was wondering why that happened there. But yeah, I see if it's in dispute, then they don't know if it's going to be on here or not be on here, and they can't really rank their credit report. So that
Correct.
makes sense. Yep,
Yeah.
yep, absolutely. Well, man, tell me about your book. Why did you decide to do that? And that's very interesting because if you can see here on my screen there, I
Sure.
actually came out with my book, It Pays to Have Good Credit, a few years ago
Mhm.
because look, just like I brought up the situation with my credit card, I use credit to my advantage and I get paid free rewards from using my credit and it costs me no interest. I also did the same starting my business, all on the credit card. So that's my slogan and I stand by that. It pays to have good credit and it has not treated me wrong since. So,
Right.
what's your story behind your book?
It's very simple. No matter how much education somebody has, no matter what they do for work, until they go to get a mortgage, they probably don't know anything about getting a mortgage. It's not taught in school. It's
Yeah.
not, it is what it is. And again, of course, it changes over time. It is also different state by state. The rules in New York State, the rules in Connecticut are going to be different than the rules in Arizona.
Yeah.
So my thought was very simple. How do I give people basic information that will work everywhere? What are the 12 steps that you need to use in order to succeed at getting a mortgage? What are the things that you should not be doing while you're in the process of trying to get a mortgage? Those things are very straightforward. Once people know that, they will usually try to act upon that and put themselves in a better situation. I also feel that, there's just a lot of terminology that has nothing to do with daily life. I try never to use acronyms. We're talking about DTI. When I talk to somebody, I say it's called debt to income. It will be referred to as DTI through here, but this is what it means because it might not mean anything to somebody who has not yet had a mortgage. When they're talking about LTV, loan to value, okay, how much have you borrowed in relationship to what the house is worth? And then there's something called CLTV, which is
Hmm.
combined loan to value, so that if you have multiple loans on the same property, property, you need to know what those total are. So again, having information where people can quickly see what do those acronyms mean, what do those terms mean, what's the implication of those terms seemed to me to be beneficial. I also figured, quite frankly, if somebody reads the book, they feel good about what they're learning, I've increased the possibility of them talking to me about getting the mortgage instead of
Yeah.
going down the street to somebody else who
There
isn't as
you
good
go.
looking.
There you go. Yeah. Yeah. I mean, I could kind of relate with the same thing, with my book. I get so many random people on Amazon, and there's just random people, man. Still to this day, I released that book in like 2021, maybe
Okay.
22, maybe 21. And still to this day, I get the email alert stating that, Amazon, KDP or whatever, they send out the royalties email. And I'm like, man, this is crazy, which I still do the email campaigns every month to all new clients who sign up. I send them a link to order the book if they wish. But man, online books, they definitely come in handy, and you'd be surprised how many random people would buy your book if you do list it on Amazon. And look, they will find you. I get so many people who send an email or they just randomly sign up. And then once I call them, they're like, hey, yeah, I read your book or I found your book. So,
Yeah.
you done good with that, man. I actually may have to check that out myself.
No, I give mine away for free. Although it has a
Great.
price on it, I don't charge people for it.
That's
Very simple.
awesome.
I want them to have the education. I figure the more they know, the better the process is going to be.
There you go. And that goes to show how much you really love what you do.
I do enjoy it.
There you go. Well, I got one last topic here, and I think this one is kind of funny because I joke around with a lot of loan officers, and this is their number one pet peeve. And I'm sure you know where I'm going with this. People get pre-qualified. They're told not to apply for anything, and they still go and apply for things. Do
Mhm.
you think that is a big risk for the I know it all type of people? Let's just say if someone's approved for a $600,000 home and they're like, I don't have any debts, but I'm gonna go and finance this new Ford F-250. I know what I'm doing because I still gonna have enough income to still afford the
Mhm.
home. So screw what my mortgage lender is telling me. I'm gonna do what I want to do because I understand how math works and I know I can still afford this home. Do you agree with that mindset or do you not agree with it? Is it as simple as knowing how much money you make and how much home you can afford if you went out and bought this $80,000 truck? Or is there more to it and there's still at risk for not being approved?
Well, it's very simple. Once the underwriter approves criteria, if any of those criteria change, even if they still stay below the range that's required, they have to rewrite the loan. They're signing
Mm,
off on something at a very particular time, space and
mm,
time. If the space or time changes, you've got to change what you've just done. They may get approved again, they may get approved 6 times in a row, but the underwriter still has to say, yesterday your DTI, debt to income ratio was 27%, today it's 29, tomorrow it's 32, but the program allows you to go to 40. So yes, you'll still get the approval, but you need to have it rewritten. The other thing is pre-qualification is and pre-approval are used interchangeably by a lot of people in the industry,
mhm,
and both of them have real limitations. The biggest limitation of either of those is there's always a line in it, no matter who's writing it, which says this is not a commitment to lend. So it
mm,
means you've got criteria that fit you into a program, but it's not a commitment. What I ask people to do is what we call a TBD, a to be determined commitment. Our bank will underwrite your loan even before you've looked at a house. When
mm,
you go out there, you're now competing with other people who have cash because I've committed to lending you up to a real dollar amount. It says this is a commitment as opposed to a pre-qualification or pre-approval that says this is not a commitment to lend. And that's something that potential buyers need to ask their potential lender if they can do it. Some banks will not do it. Mortgage banks like ours absolutely will do it because we put everybody in a better position.
I see. Well, man, I've learned so much just from this 45 minutes of us talking here, man. I mean, like I said, I know about maybe 75% of the stuff just dealing with so many
Sure.
affiliates. Like I said, I got so many loan officers and realtors who send us clients when they aren't in the spot to get approved for a home at this time, but they may later this year, and vice versa. And, I just hear so many situations and lenders tell me this, lenders tell me that. So, like I said, I know 75% of the stuff. The other 30% of the things, I'm like, I think this is right, but I don't know if it's right. So, there's still some small gaps that I still need to learn. But man, some of these questions here that I brought up as topics, you've done a very great job in this episode, man, just going over those. It was easy to get answers to those. But most importantly, for an audience who is listening or watching this episode, how can they get in contact with you? How can they find you? Most importantly, what is the best way to connect to your book? Do you only serve one state or can you help people in multiple states? Tell us about that.
Okay, so I personally lend in the state of New York and the state of Connecticut, and I
Perfect.
work with a team that will lend everywhere except Alaska and Hawaii.
Okay.
People can get in touch with me very simply. 914-380-0600. You can call me. That line will come right to my pocket. You can text me. That will come right to my pocket. If you prefer an email, it's skolnick at unitedmortgage.com. But for simplicity, send me a text, call me. Once we've done that, I'll find out whether you want the book physically or you want to go online and get it. I'll tell you how to do both, and then we can move forward. Doesn't get simpler, I hope.
All right. But that sounds good. Well, Sol, I thank you so much for joining this episode, man. I hope we can connect again in the future. I would love to have you on another episode, just bringing up more topics about home buying. But other than that, man, if you don't have anything else, that is all for this episode.
Christopher, thank you very much. I really appreciate the time. I enjoyed learning about the part of the credit perspective
Yeah,
that you've
yeah,
given me.
absolutely. Yep.
And I look forward to never having to ask for credit again.
Yeah, absolutely. Well, that sounds good. Well, thank you so much. Thanks for tuning in to this episode. If you wish to be a guest on our podcast, visit StirgusCreditRepair.com and click the podcast page to schedule an episode. If you need help with your credit, you can also sign up at StirgusCreditRepair.com and start your free trial today.
Stirgus Credit Repair. Stirgus Credit Repair. If you want a new house, call us. If you need